That is the word coming from HAL. They're also looking at some foreign partnerships. So that is the conversation over there. But let's now get you some important updates from the macro front. After cooling for 2 months, inflation in January accelerated to a 3-month high of 6.5%. So Lata is here to tell us more about the numbers and also the kind of impact that it could really have on the realty sector. But Lata, at 6.5, it's well above the estimates that we were working with.
Yes, that's the real worry. It's above the 2 to 6% mandate within which CPI has to be kept. But more importantly, 6.5 was not even the most pessimistic estimate on the street. The poll was 6.1%. And what's bad is it's entirely driven by food. Food was 4.19% higher in December. It's 5.94. I mean, almost 1.8 percentage points higher in terms of the momentum with which food inflation is rising, largely led by cereals, which has a 12% weight in the entire index. I mean, it's a national staple food, and cereals has gone up by 2.6%. Month on month, 16.2% year on year. And the WPI numbers which just came out are also indicating that cereals inflation is up about 1.9%, even at the wholesale level. Now, all this has led to a fear that the Reserve Bank is likely to increase the interest rates quite definitely when we come to the April policy. Until now, it was like a 50-50 expectation. Now, practically everyone has moved to a rate hike assumption, and that is very clearly reflected in the bond market rates. The bond market 10-year yield itself has moved up by about 3 or 4 basis points. 736, it closed, touched 7.4 in early morning trades on Tuesday. More importantly, the OIS, overnight index swaps, which is a very clean market where you can express your fears, there the yields have gone up by 10 basis points, clearly indicating that a rate hike is now getting discounted. The biggest sufferers on the equity markets were the real estate companies. For them, it's not just a question of higher cost of money, which is, of course, for the entire country, but real estate companies tend to be heavily dependent, are heavily leveraged. So the cost of money increases for them. The demand may simultaneously fall when, buyers of homes are faced with higher and higher EMIs. They may go for smaller homes or cheaper homes. So the realty sector is clearly indicating that, the higher rates are going to, hurt them rather badly.
All right, Lata, thanks a lot for getting us that complete roundup on what's happening on the CPI front. The real estate